It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Now, the negative gearing and CGT changes, they have dramatically shifted investor attention into new housing stock. Many talking points here, and many investors are now asking whether new builds have become the most tax-effective property investment available. Have the budget changes fundamentally changed the way you, the investor, thinks about depreciation and property selection?
Firstly, thank you for having me on, Craig. It's a pleasure. Look, we've certainly been busy. There's a lot of clients have been ringing up asking how the change will affect them, and obviously my staff as well. So there's certainly been some big changes afoot in terms of negative gearing. In terms of depreciation, well, it definitely does skew, in terms of negative gearing, it definitely does skew people towards newer properties. Mathematically now, it is far better to buy a newer property when you just do the maths on the table compared to a second-hand property. Not just because of negative gearing, but because a second-hand property, you can't claim the depreciation on the plant and equipment assets. So it's a bit of a double whammy, to be honest, these changes for new properties. So I think that people selling new properties are dancing down the street, Craig.
Well, many investors, of course, they are focused on these negative gearing and CGT changes, but depreciation remains one of the most overlooked tax benefits available. Even under the new rules, depreciation can improve cash flow and reduce taxable income. How much money could investors be leaving on the table without even realising it?
For something new, say for a two-bedroom apartment in Sydney, you're looking at about $25,000 in the first year alone as a deduction. Now, with the second-hand properties, you're looking anything built after 1989, you're looking at anywhere from $5,000 to $15,000 per annum. So it's quite a substantial benefit, and it really helps your cash flow, especially if you bought it before the budget. So, and you've also got another year now left of claiming those depreciation out as an outright deduction. Moving forward, what will happen is those, except for if it's brand new, if it's brand new or commercial, they're excluded from the changes. But if it's second-hand property, what will happen is those losses that you could claim against your taxable income, they'll just be carried forward to a pool above where, when you start becoming a positively geared property, you eat into that pool. So it's still worthwhile.
Yeah, and renovations, they can help improve both rental appeal and depreciation outcomes. In fact, new assets may create additional deductions, while scrapping old assets can sometimes unlock further tax benefits. And in a market where investors are reassessing strategies after the budget changes, do you think that there is enough property owners maximising these renovation-related deductions? What do you think?
I think, no, I think the answer is no, that there's not. I think we see a lot of people that have renovated a property and they aren't aware that just because the property is old, that when you renovate a property, it starts again, the building allowance and the plant equipment reset. So you might renovate a 1800-year-old Paddington Terrace, but when you do the renovation, or even if it's bought renovated, you can claim those renovation deductions. And I think you're right. I think a lot of people don't realise that just because you didn't do the renovation doesn't mean you can't claim the renovation.
It is a Tuesday afternoon, and it is time to find out what the RBA has done today. Australia's major banks and most economists have been expecting the Reserve Bank to leave the cash rate unchanged, and that's exactly what happened today. It reflects the balancing act the RBA is currently facing. After 3 rate rises already this year, the RBA wants more time probably to assess the impacts of those increases before making another move. World economies, they really are teetering on this whole Strait of Hormuz situation. And for borrowers, today's decision provides some short-term certainty. We certainly need that. It might be short-lived, but hey, take the win, because there is no guarantee that tomorrow won't see the goalposts changing yet again.
We are your local source for unbiased, expert insights into the world of real estate. We are not a real estate company. Our only objective is to help you better understand the real estate market.
Are you thinking about putting your property on the market using an auction either in Melbourne or Sydney? If so, how nervous are you regarding these lower clearance rates? And I guess I should throw off the first question about the RBA with their decision on Tuesday. What did you make of it?
Yes, good morning, Craig, and hello, everyone. It's great to be part of the program. Well, it was not unexpected. I thought the RBA is going to keep rates on hold because of all the uncertainty that's out there at the moment, with the Middle East crisis and the changes to the housing rules and the budget. So I thought they're going to just wait and see what happens. So not unexpected, and probably, a great relief for a lot of people that 3 rate rises might be the end of it.
Yeah, the thing with the RBA is you can't pick it. There would have been people just on tenterhooks on Tuesday waiting for that announcement, but thankfully there was no raise with the cash rate. Also, there's a lot of concern about, is the market going to crash? I mean, we've heard all of this before, but what are your takeaways for a lot of the commentary talking about 20, some people saying 30% crash, which I think is crazy?
It is. I've studied the property market for a long, long time, and I went right back to 1901 and looked at the performance of the property market right back to Federation. What I saw in looking at all the changes in prices over time is that the worst we've ever done, and that was during the Great Depression, and it took about 3 years for property prices to fall by about 20%. Now, that's the worst that's ever happened, and we're not looking at anything like that right now. The fundamentals of the property market are quite sound. So, I think talk of a crash is absolute nonsense. It may soften a bit. People are uncertain. They're not quite sure what's going to happen. They're holding back, but we've still got a massive shortage of property. So prices will continue to rise over time.
Yeah, and in terms of a crash, you've also got in the mix of this, and I think a lot of it is coming from first home buyers. They're unsure because things have slowed down somewhat, especially in Sydney and Melbourne. But they're asking, is there an upper limit to housing prices? How do you explain that, especially to first home buyers? Because they're looking for some good news, but unfortunately, I don't think it's coming with that particular question.
It's very difficult for first-home buyers to get into the market. The government has made it a lot easier with their 5% deposit guarantee. So that's enabled a lot of first-home buyers to get in with lower deposit, but they've still got to be able to afford the repayments. So when interest rates go up, it makes it harder for them. But when you look at the overall market, first-home buyers are about 10% of the market. People, after about 4 or 5 years, they tend to upgrade. They have less reliance on finance and they've got more equity. When you look at the top end of the market, the well-established suburbs, people own their own homes without any debt whatsoever. About a third of Australian property is owned without any debt. So that means that prices in those areas can keep on going up. So the good news is once you're in there and you're a first-home buyer, you've got your home, it's going to go up in value, you can upgrade over time and that growth will continue. The trick is, of course, is getting into the market in the first place. Hopefully interest rates will start to reduce and make it easier for first-home buyers to actually enter the market.
And right now, let's catch up with Jess Doolan. She is in the ACT. We have got another property tip coming to you. And Jess, you would like to tell everybody, advise people about what?
I would like to advise a lot of sellers in the market. We get the question all the time, is it too early to take an offer? I would say in our market right now, it's never too early to take an offer. So as an owner, be prepared that you will find your buyer in the first 1 to 2 open homes. You definitely want to take advantage of negotiating quite quickly in a market that is oversupplied.
Yeah, it's something that we've talked about before because for whatever reason, it gets into somebody's mindset that when that first initial offer comes in, if it's quick, they think they've priced the property wrong.
Absolutely. And I don't necessarily think that's the case. I think 80% of buyers that we find in our office are within the first 1 to 2 open homes. So people that are coming through properties in the first 2 weeks are your most qualified and urgent purchasers. They're circumstantially wanting to lock something down quite quick. In this market, the longer that you sit on the market, the more consumers start to question why. So you definitely want to be negotiating from points of leverage, and that generally is quite early on.
First home buyers, let's talk about them in the region. Just how active is that cohort of buyers?
Yeah, well, I mean, for us, I guess our average sale price sits anywhere between that sort of $2.3 million to $2.5 million marketplace. Our entry-level market here, with the exception of retiree-type living and over 55s units and things like that, our entry level into our market for townhouses and units is probably somewhere in that $1 million range. So we don't have a huge amount of first-home buyer activity in this particular suburb, but certainly further west, where our entry-level residential houses, say the areas of Box Hill and the like, we're certainly seeing an increase in numbers there off the back of the 5% scheme and things like that in recent times.
Don't navigate the real estate market alone. Let us help guide you in the world of real estate every day. Make better informed decisions with the latest news and insights.
You're sort of drilling into the prestige market as well. And we had these millionaire rows, very exclusive, very luxury pockets of Australia. However, that has really changed now from millionaire rows to billionaire. Quite the change.
That's just it, isn't it? Over the years, or over the last decade particularly, what $1 million means has changed significantly for Australia, and especially when it comes to property prices. I think PropTrack said that the capital city median is now, or at least for the month of May, was over $1 million. So that's the median of what you'll pay for in a city in Australia. So it's not exciting anymore to talk about millionaire rows. We're talking about billionaire rows, and there are a few of them, most of all, mostly in Sydney's eastern suburbs, but Melbourne's claimed a few, and those are really individuals that are willing to pay $50 million or more to get into a property. The only problem is the vendors aren't selling because they don't need to.
Kirsten, I wanted to talk about the expansion of boutique apartments. This particular market seems to be ever-changing. A couple of weeks ago, we were talking about the cost of providing car parks in apartment buildings. I had no idea just how expensive that is. I think from memory, for a two-bedroom, it's adding something like $120,000 to your bill, your purchase bill. But yeah, it's becoming very nuanced. It is changing all the time. People's tastes seem to be moving from year to year. Is that something that you've found in your reporting?
Yes, look, in the last 10 years or so, it's been very interesting to see what were the perks in an apartment building, maybe a well-equipped gym for residents or a gorgeous pool with a deck. You know, those are kind of must-haves now. We're talking about buildings that include wellness centres. So they've got to have, beyond the swimming pool and spa, which are now standard, they have infrared saunas or circadian lighting to help with well-being. You don't just have a hot tub now, you've got to have a cold plunge pool, and all these things that are included in boutique apartments that we probably just didn't see even 10 years ago. And the appetite is growing for even more wild and wonderful things.
We do a lot of reporting on Aussies heading over to Dubai, and this has been happening over the last 3 to 4 years. You talk about the wellness centres, the saunas, etc. There is just this luxury expectation now. A lot of the developers are just listening to what people want. And I wouldn't mind betting that there has been a number of developers that have gone over to the UAE, especially into Dubai, looked at what those developers are doing, the way that they're upscaling, and have brought it back to Australia.
Yeah, that's absolutely true. I have spoken with some developers and architectural groups who are using the Middle East and even Florida, interestingly, as examples for what they could bring down under. And one particular thing that we haven't seen a lot of in Australia and may well do, that other countries are doing, is branded residences. We have a few that might hold a hotel's famous name, but we've got several Middle Eastern countries and Florida, and they are covering everything from Maserati to Bulgari to Chanel, Fendi. These are brand names you usually would see on handbags and shoes or cars, and they are putting it into real estate, and people are lapping it up and paying a premium.
And some of these branded residents, they will, particularly if it is a car manufacturer, they will throw in a car as well, which ain't too bad, but mind you, you're kind of paying for it at some of the price end.
Well, absolutely. And what's interesting is, and I think we haven't seen the example yet, some of these brands will put their name to a building for a certain period of time, but they don't necessarily promise that it will always be that building will be branded with that name. So I think that's really interesting for people who are buying in for the brand, for buying in for that status. But when they go to resell, if the contract is up for brand X, whatever it may be, what will their resale value be? So I don't know. I think Australia might be taking a very considered approach in whether we go as far into branded residences as some other destinations have.
We connect you to the best real estate information across Australia. The Real Estate Podcast.